You're listening to Power Producers Shop Talk, where we are refining and redefining the sales game by equipping you with the tools you need to differentiate yourself in the marketplace.
Well, it's like when we audit the mod with Mogic and give them the action items that they're going to use to lower their total cost of risk.
Tactical skills that will help you provide deliverable value to your clients and prospects.
Technology is not an expense, it's an investment. Look at what Think HR has done for our clients and even our team. It's an amazing product, and I'm so thankful we have that.
And action items that you can provide to take your prospects and clients to the next level.
Things are changing for us in 2021. Not all big business anymore. Now that we have CoverWallet on our team, it's amazing that we're going to be able to write small business profitably.
This is Power Producer Shop Talk. Production redefined. Are you ready to feel the power?
Hey everybody, welcome to Power Producer Shop Talk. We are here on a Friday with you. Number 3 of the sessions we're doing with Kevin Ring from the Institute of Work Comp Professionals out of Asheville, North Carolina. And we are going to talk about one that is actually immediately relevant in my agency. And I know that a lot of you have struggled with this, but it has to do with ownership changes and how they affect the workers' compensation program for a company. So, Kevin, I could almost just let you do a freaking soliloquy on this the entire time because I can't bring much to the table. I was telling Kevin when you were in between the podcasts that you have this account we're working on right now.
Yeah.
And you're consistently coming to me and saying, hey, what about this? What about? And my answer is always the same. Fill out the ERM, fill out the ERM, fill out the ERM, because look, if there's a place in anything at all with workers' comp where I would say that I'm weak, that's where it is. I just have not taken the time to learn. And again, this goes back to what I tell people all the time. This is a me problem. I haven't made it a priority. Now it's going to be a priority because I don't like not knowing stuff, but I've just not really spent the time to dive into the mechanics on what happens when entities, merge or are acquired or whatever else. So I'm extremely interested to hear, and I gotta believe Kevin's gonna bring the heat on this because this is the topic. This is one of the topics he mentioned that he wanted to talk about. So, Kevin, I'm just gonna turn it over to you and let you talk a little bit, and then Kyle, you can sort of lay out what you're dealing with right now and hear what Kevin has to say about that.
Mm-hmm. Well, the first thing that I want to say, and I apologize, I'm getting over a cold, so I'm clearing my throat a lot, but is that the rules that I'm about to talk about are specific to NCCI. The rules are wildly different in Pennsylvania and Delaware. They're slightly different in California. Everywhere else deals with this fundamentally the same way, which is that common majority ownership drives the experience mod. So all I'm talking about here is how this impacts the experience mod. It does not matter how the policies are written. If I own a flower shop and I own a dynamite manufacturing facility, and both of those are based in NCCI states, they are going to share an experience mod. It does not matter that they're on two different policies. And it doesn't have to be just a single person. It can be, a collection of people. So if David and I own company A 50-50, and then David, Kyle, and I own another company 33% each, well, between Kevin and David, we own more than 50% of both entities, and they're going to be on the same mod. I love the gray areas of workers' compensation. But I tell people all the time, this is not a gray area. It is required by the rules that if entities share common majority ownership, that they be combined. And NCCI's rules about what happens if they aren't appropriately combined essentially say that they can do whatever they want going back as far into the past as they want. And so this becomes an issue when you have a client that owns multiple businesses and they don't want them.
So what is the thought process behind that from, the So because the business owner obviously is going to have questions about that. They're like, well, why do I need, and I know one of the answers, in my head, but I think that a lot of people probably have that question, and I know that the business owners do.
Meaning, why is the rule the rule?
yeah,
the way
I mean,
that it is?
Yeah. Why? Okay. So if I've got a flower shop and a dynamite shop, those are two starkly different things. Why are they on the same mod?
Right. Well, and I'm very fond of the answer that, the why isn't my business. When you buy the policy says that it's governed by the manuals of rates and rating plans approved in the states where the policy is effective, and this is the rule to a certain extent. And we have children. We understand how unsatisfying because I said so is as an answer, but sometimes that's just the answer. Now, I think, to my mind, the number one reason for this rule is to avoid people from manipulating the experience mod. So the number one thing, and I'm sure that both of you have dealt with this in your career, you've got a business and their experience mod's a dumpster fire. And so they ask, well, can I just start another company and move everything over there and start over with a 1.0? And the answer is no.
No, so now they figured out they
that
just go into an
experience is
employee
going to
leasing
transfer.
company and do the same thing, right? That's the trick.
Right.
My answer to Kyle for that would be, because if you're a sloppy operator, you're a sloppy operator. And I think that's
Sure.
probably what the
Well, I think
fundamental
that's the other piece
Yeah,
of it.
that's the fundamental reason
Yeah.
behind it is if you
Yeah.
suck at operating a flower shop, you're probably going to suck at operating a dynamite manufacturer too.
Definitely.
Yeah, I mean, I think those two things are the, it's that thought and the, keeping people from cheating the system. I think you've probably covered 95% of the rationale for that. And, it's that, the first thing agents have to do when they write a piece of business is figure out, are there other businesses? And I frequently ask in our workshops, well, how would you know if this business owner you're working with has ownership interests in other businesses? And
Ask them.
generally, well, right, but
Right.
why would you ask?
Well, yeah, but the other thing is we know that. So just
It's,
on the front end, if we're doing our job right as producers, and again, I can't speak for any other state other than the state of Florida because I don't do this there. Before we ever even go to a first meeting with people, we go to the Department of State and we pull. I do a search by that person's name, and it'll show me any registered entity that's affiliated with that person where they're an owner or an officer. And that's really important for you to do. Like, you should know that. And it's going to bring up things that may be irrelevant. Like maybe they have an LLC that's registered in the state solely for the purpose of holding their boat. Maybe they are on a nonprofit board of directors. That's probably relevant information, both from a personal lines and a commercial perspective. But you can at least get a list of all the things that they're attached to, and then it's a more natural questioning to say, "Hey, I've done some research. It looks like you're affiliated with this, and this. What did I miss? Is there anything else out there?" And it's at least a better look for you as opposed to going in and just saying, "Hey, you own anything else?" At least
Right.
put some effort into it. And I know that Kyle does that, but I mean, if your state has the ability for you to look up by someone's name what they're attached to, do that every time. Like that's basic blocking and tackling for me.
right. Well, and it's also, I mean, I actually just brought up the application to have the exact wording. Question 5 under general information on the workers' comp app is applicant engaged in any other type of business? And it's just a question that it's information you should have. And I love what you're saying, David, about looking them up. That's very good. And just because they have an ownership interest doesn't mean automatically that it's something that's combinable. They might own 10% of something else, and none of the owners of that other entity are involved in the one that you're insuring, but you want to know about.
Well, Florida takes it a step
And-
further, man. On our app, on our Cord app, which is a Florida-specific app, it asks you the 2 questions on the last page, right above where the signature fields are. if you if you own 50% or more of another organization or whatever. I mean, it has two very specific questions. And here's the problem. People just pencil whip that application, right?
Yeah.
The producer goes, they bind the coverage, and they're like, oh, crap, I didn't answer anything. They probably don't own anything. Bam, bam. Next thing you know, they're out. Meanwhile, you find out this guy's got 15 different construction projects under different LLCs that he owns all of, and you've now just falsified an application, or your client has. Your client hasn't answered the question appropriately. But 99% of the time, I'm going to tell you that the producer does not go in and ask those general information questions, and they don't ask the combinability questions in Florida, and as a result, they create the problem for themselves.
It is shocking to me, David. Absolutely, it's ruined my day that you would suggest that any agent has ever not asked their client every single question on the application before they completed it. That is completely new information to me. I'm sure no one listening to this podcast has ever done that. You're absolutely right. Is that, and it could be, something as simple as, like with hotels are a great example. If you own one hotel, especially if it's like a franchise, a name brand hotel, if you own one, probably better than average chance you own more than one. And each of those is very likely in its own LLC because that's how the lawyers and the accountants want it done.
Well, that's because they get paid more money to do it that way.
Well, yeah, and there's asset protection pieces to it, all of that. But if you're calling on one hotel, are you asking if they have ownership in others? Are you, when they look at buying something, and this is where, a huge chunk of the questions that we get come in, which is, my client is looking to buy or sell or has bought or sold all or a piece of a business. What happens now?
Right.
And that's where things get really confusing.
So, I mean, I guess I can jump in right there and tell you about the situation unless you got something, David, that you wanted to say.
My question is, and this may answer your question for you, but let's just say that we're seeing a lot of consolidation in the insurance industry. We're seeing it everywhere else, too. Service contractors particularly have been very attractive targets for venture capital funds right now. Or larger service contractors that are doing what agencies do and grow through acquisition. So my question is, let's just say I've got a service contractor and I'm pretty good size, and there's a couple more that are smaller than me, and I decide that I want to acquire those and bring them in under my umbrella. When the new mod is calculated, is it as simple as just taking the unit stat cards from all of the entities, putting them into the software that they use to calculate this, and it's going to spit out a combined number, or is there more to it than that?
So what I would do, and let's just assume that they all have the same effective date, because that makes it easier to think through. So let's imagine they all have a January 1st effective date. Then
that's note number one, Kyle.
If they don't have the same effective date, then you just have to figure out which one's going to control the effective date. But so you wait for the transaction to happen. You submit the ERM-14. I'm a fan of submitting the ERM-14 to the Bureau. I dealt with a situation last week where it was kind of a complicated deal, actually with venture capital, and they submitted it to the company, and the company pushed back. And I said to the agent, I mean, the questions they're asking aren't necessarily
But it's also not the company's decision.
It's not the company's decision, right? They're just going to pass it along to the Bureau. So cut out the middleman. You're going to have to tell the insurance company, that you've got this new payroll and whatever it is. But, send the ERM-14 to the Bureau and let them ask questions. So you submit the ERM-14, and then what's going to happen is all of those January 1 mods are going to get combined, and a revised mod is going to be issued that's going to be effective retroactively to the date of the transaction. And this is where it's really important to delineate how NCCI handles things versus the other states that I mentioned. There's one or two independent bureau states that haven't adopted the change in NCCI's rules. About 2 years ago, NCCI changed their rules. It used to be you have to report it within 90 days of the transaction. If you do that, it's retroactive to the date of the transaction. If it's after 90 days, we're just going to issue a revised mod on the next mod date, whatever that should be. But they changed that rule to say we're going to revise the current and the 2 prior mods, and the insurance company is responsible for either charging additional or returning premium retroactive to the date of the transaction, or the current or 2 prior mods, whichever is more recent. And so what they did was they closed a loophole where you could say, oh man, combining these 2 entities is going to be bad for my client. I've got a really busy next quarter. I'm just going to wait like 4 months to complete that ERM 14. And then I can kind of skip a year of the impact of that. And they closed that loophole. I don't think it's necessary to go back to the unit stat reports. I would just use the mod worksheets. Now, where a lot of people get confused, excuse me, is they'll say, well, is it just the average? Like, how does that work? And it's really important to understand that it's an entirely new experience rating, right? That all of the payroll and claims are now all on this single mod. So presumably the expected losses are higher. If you're an NCCI, that's going to impact the weighting value. That's going to impact the ballast. That's going to ultimately impact the stabilizing value. So it's not as simple as, well, this company has a 75 and this one has a 125. So when they combine, they're going to be a 1.
Yeah, no, I always wondered if it was as simple as just taking, and I said unit stats, but I really meant the mod worksheet, and just taking the data from that like you would be doing. Let's just say you were going to put it into Mod Advisor. Would it be as simple as taking all 3 worksheets and putting the data from all 3 into Mod Advisor and letting them calculate what the combined mod is at that point?
Yeah, if they all have the same valuation, if the same mod effective date, the answer is yes. If they don't, then you have to determine what's the actual effective date of the mod going to be, and then you have to figure out what policy periods fit on that mod based on that effective date, which then takes you down the experience rating period.
No, that's an immediate red flag for me that this goes directly to NCCI. Do not stop.
If they're different dates.
Yeah, different dates.
Well, I mean, I would argue. I mean, yes, it needs to go to NCCI, but I think if you've got a client, it's worth figuring out what they should expect. And we talked about this earlier, David, not in the podcast, but before we started talking, is, when do you want to know, as an agent, when do you want to know your client is considering acquiring all or part of another business? Well, you want to know before it happens. And before I continue on that rant, let me make very clear probably the number one misconception that I hear about ownership changes, which is, well, they just bought their assets. Well, it doesn't matter. By the rules, and if anybody wants to dig into this, in the NCCI manual, it's Rule 3C, specifically 3C1 of the Experience Rating Plan. It outlines what is an ownership change, and certainly that's sale, transfer, conveyance of all or a portion of an entity's ownership interest. But it's also the sale, transfer, or conveyance of an entity's physical assets to another entity that takes over its operations. In the world of small and medium-sized business transactions, it is unusual, not unheard of, but unusual for the actual entity itself to change hands for a variety of different reasons. They sell the equipment, the intellectual property, all of that, and the employees transfer over, and they continue doing what they're doing. The fact that you did not buy the entity does not get you out of buying their experience. And if your client is calling you before they do this transaction, then you have the opportunity to help them understand this is what the impact's going to be. This is how you can expect it to change, what's happening with you going forward. If you have a client where they're very mod sensitive, because if their mod creeps over, say 1.0, they're not going to be able to bid on jobs or whatever, they would really probably prefer to know that before they sign on the dotted line. But too often, agents are finding out later, hey, we just bought this company. Like, what do you add them to the policy? Well, it's not, it's not that simple. And if you ever really want to know if you're a trusted advisor to your clients, I would use that as a yardstick. Do they call you before they make a big business changing decision, or do they call you after? Because they called their accountant and their lawyer before.
Right.
Let me ask you this, Kevin. I think one of the things that probably bothers agents the most is the turnaround time of getting information back from NCCI. Because of how versed you are in this, is this something you're able to project? Is that a fee-for-service thing that you do at the Institute?
We don't do direct mod projections. I'll certainly help folks work through the impact and kind of do some back of the envelope math of what that might look like. But we encourage all of our folks to have access to some type of mod analysis software that's going to answer the question more accurately and more quickly than we could probably do. Now, what we do all the time, and part of our workers' comp help desk, is you call and you say, hey, my client is looking to buy this business, or my client has bought this business. Here are the two mods. What's gonna happen? Okay, well, so let's talk about, are the effective dates the same? If they're not, which of these two entities is going to control the effective date going forward? What policy periods are going to fit on the experience mod? How can you counsel your client? And if they're talking to you pre-transaction, are they going to back out of a business deal because this company has a 175 experience mod? Probably not. But could they negotiate some terms? It's kind of like when you send in the home inspector before you buy a house. Are you going to not buy the house? Probably not, unless it's on a sinkhole. So catastrophic.
Yeah, completely egregious.
But you absolutely can negotiate some different terms, because if you're buying this really bad experience, then you can figure out what the impact is going to be.
Yeah, and I think a lot of the business owners that we deal with just don't really understand how that works because, frankly, like David said, there's a lot of agents that don't really understand how it works, myself included at some points. But, the particular prospect that I'm dealing with is just that. It's a prospect. So I didn't, have that relationship beforehand, but, it was a service contractor, like David said. They purchased a bunch of smaller businesses in the same industry, back a few months ago. And I'm talking with the prospect yesterday or the day before on the phone, and they're like, well, yeah, we were thinking about, we want to just try to keep everything separate. I'm like, okay, well, that's not how it works. But, I can understand why you would want to do that. But, it's, it definitely can be confusing for them, for sure.
Well, and you can insure them separately, right? Like you can write a different policy for each of those businesses. They just need to share a mod.
Yeah, unless your carrier throws shade at you saying we want all of it on one policy. We've had that happen, but that's a carrier decision.
That becomes an underwriting issue because, and especially if they're smaller businesses, they might not want just this one little piece that performs poorly. They want the whole thing if they're gonna take that bit, and so that's a different question. But with the exception of Pennsylvania, there's no requirement that they be insured on the same policy in order to be combined.
So let me ask you this: what happens if they don't disclose it? What happens if they don't disclose it and somehow you manage to make it 12, 18 months, and then boom, you find out all of a sudden that there's like 3 entities that you had no clue even existed? And look, be so hard for this to happen, but what wouldn't be hard to have happen is your client can acquire things and not tell you about it, right? So is there a penalty? Is there a penalty that's imposed on the client if they make acquisitions like that and don't report it to NCCI in a timely fashion?
Yeah, so rule 3F of the NCCI Experience Rating Plan is titled Evasion of Experience Rating Modification. And it goes on to talk about that, businesses may take steps to evade the proper application of an experience rating. Some of those may be, they don't use the word nefarious, but they're essentially saying, like, some people might do something intentionally to avoid it. Other times it might just be the business, like what Kyle was talking about. Hey, we just want to keep everything separate. NCCI doesn't care. What they say is they can combine experience that would otherwise not be combinable, separate experience that would have been combinable, exclude experience that would have been included, and the list goes on, and there is no statute of limitations on this rule. And a very reasonable question here, and one that I get asked pretty frequently, is, have you ever seen this happen? And the answer is no. What we've seen over time, and I expect that you guys have seen this in your business, is that NCCI tends to take the view that, hey, these rules are complicated. Most people really don't understand it. If you're reporting it to us now, that's cool. Now, as I was explaining before, the NCCI rules now, if you had a ownership change that happened, say, January of 2015, and it gets reported at the end of 2021, they're going to combine the current and two prior mods. And if those mods change, the carrier or carriers that were involved have the right to collect additional premium based on the change in the mod, or the responsibility to return premium if the resulting mod is lower for one or more of those entities. My concern for businesses that do this incorrectly as we move forward in time is that we've seen some evidence that NCCI is improving their ability to find these things in an automated fashion. Because when I've asked NCCI, hey, there's this rule, have you guys ever dropped the hammer on someone the way that's described in this rule? The stories that I've been told are people kind of by chance discovering two entities and then doing some investigation and finding they should have been combined. Two companies with the same mailing address that have different experience mods. But multiple times over the last 18 months, I've talked to agents where NCCI has reached out to insurance companies, and because they've flagged claims that look funny. One specifically I remember was a $60,000 medical only claim. And NCCI said, this can't happen. You can't have a $60,000 claim that is medical only. You're going to need to explain to us why there was no indemnity on this claim. Well, there is a 0% chance, given the volume of data that NCCI receives, that a human saw this on a screen somewhere and flagged it. That had to be some sort of algorithm that's looking for things that are outside of a certain set of parameters that they've defined. And I strongly believe, although this is just a hunch, and I don't have any sort of hard data behind it yet, but I strongly believe that if they're using machine learning and algorithms to find things that are out of place on claims, there's no reason that's not eventually going to extend into this kind of conversation with ownership. And there is almost always going to be data that ties these things together with the policy information that gets submitted to the Bureau.
Yeah, I agree. I think that it's going to be interesting to see what machine learning does specific to this over the course of the next 5 or 6 years, if not sooner.
Yeah. I mean, so my position on it is that if you have a client that is in a situation where they aren't, the client has to sign the ERM 14, right? Like, it's not, we can't go filling these out on behalf of our client and submitting them. That's not cool. And if they say, well, I'm not going to sign it, well, then you have a decision to make. But the answer I'm always going to give is, this is a black and white question. Like, there is a right way and a wrong way to do this. If your client refuses to do it the right way, then you have a decision to make about whether or not you want to continue to work with them. And I won't judge you regardless of which decision you make, as long as you've made it very clear to the client that should someone somewhere catch wind of this being wrong, that it could come back and smack you in the face regardless of your refusal to do it yourself.
Yep. Kyle, answer what you want to know.
Yeah, I think that was pretty solid. Definitely, took some notes here. I'm all good on that now. Things have been cleared up.
3C1. That's all I'm going to tell you.
3C1.
Come on, lady. 3C1. What are you doing? Well, anyhow, listen. This is the last recording before we sign off for Christmas. So I hope everybody has a great weekend. I'm getting ready to start my Christmas holidays, Kevin. I know your family celebrates Hanukkah, so you're wrapped up, aren't you?
A couple weeks ago.
Yeah, that was just after Thanksgiving, but our daughter's home from college, and our high school age son is home and chilled out. So we're going to enjoy the weekend. We're going to have some Chinese food, as is the tradition of Jewish people on Christmas Day.
Shoot, man, you could go swimming with the temperatures there.
Right, there you go.
Yeah, all the pools are closed. It's they still close the pools on Labor Day, no matter
unbelievable,
no matter what. But we hope you guys have a great Christmas, and we'll look forward to talking to you.
Sounds
soon.
good.
Thanks,
Everybody,
man.
have a great weekend. See ya.
You've been listening to Power Producers Shop Talk. You can follow us at the Power Producers Podcast on Facebook and Instagram. And if you want to take your game to the next level, check out our commercial insurance training course at killingcommercial.com or visit Amazon to pick up a copy of our international best-selling book, The Extra 2 Minutes.